upside for that defensive trade. Let's bring in Fundstrat's global head of technical strategy, Mark Newton. So welcome back. I mean, people still say that this is the place to be. Well, what do you make of this defensive trade that, okay, so it's underperformed to start the year? The year's young.
Hey, Scott. Well, a lot of this is simply mean reversion, which happens most years as you exit an old year and into a new. And you mentioned it initially, trash to treasure. So the three top performing groups this year have been last year's laggards: consumer discretionary, communication services. And, we've also seen great movement out of, materials and real estate. But the winners last year outside of energy were all the staples. Utilities and those groups are the worst performing. And recently we've seen evidence of, utilities and staples breaking down to multi-month lows. So, it's unusual because people are still very skeptical of this rally. But when you start to see the defensive groups really falling out of favor, it's unusual to expect a big market decline. Ordinarily, that's the time you really want to be bullish when something like that happens.
What's the most expensive area in so-called defensive stocks? Staples or utilities or something else? What would you say to that?
Well, I'm a technical analyst. I don't necessarily look at valuation and cheap versus expensive, but I say all those areas are ones to avoid this year. You really want to be involved in materials and energy and healthcare. Those are groups that are certainly show the potential to lead. And I would argue that technology is going to have a much better second half and should start to move higher in the second half of the year. So look, it's all been Europe, it's been EM, it's been China's Golden Dragon. Those are all up 10 to 15%. Our own market's up 2.5%, much better than many expected. But let's not forget that the year not only got off to a good start, but we're in the best quarter of any of the 16 quarters that represent the presidential cycle. So many people are expecting the market's going to go down. The economy and the market, if anything, I think that's consensus. And the market's already shown that it's starting to do a lot better in the first part of the year. So I'm a little bit more optimistic, I think, than many.
You're more optimistic on the market itself? So when someone says, man, Mark, I mean, the last couple of days, pretty nasty. This rally looks out of steam. What do you say?
Well, in the short term, we did have a pretty healthy rally. We've not broken downtrends yet, but the internals of the market have actually grown a lot stronger. We see the percentage of stocks above their 200-day moving average are now above 60%. Excluding technology, the market's actually in much better shape. And that's thanks to really industrials, financials, healthcare, other areas of the market where most aren't concentrating. And so, my thinking is when tech kicks into gear, and that could be as early as next week, that we're going to start to have a much better first quarter, meaning February and March are likely going to be strongly positive at a time when everybody's negative.
So you think earnings in tech are going to be better than feared?
My thinking is there's a turning point coming, and it should be a low coinciding with, an 80-day trading day cycle that I've discussed on your show before. And it's really pinpointed almost every major peak and trough over the last year. And so until that ends, it's showing that late January is going to be a pretty meaningful low in the market, and stocks likely trend up into the middle part of March. So, look, rates broke down yesterday. We saw the 2-year, the 5-year, the 10-year yield all break down. The correlation has still been very, very strong between treasuries and equities. Until that starts to deviate a little bit, if rates are breaking down, I want to be long stocks. I don't necessarily want to be betting on a big decline. And so we'll see if that how that shakes out.
Of course. But lastly, why do you believe that would continue?
Well, inflation continues to roll off. I think that's a key piece. And Tom Lee has been discussing that for months now. And I think that the market is respecting inflation falling much more so than it is punishing the market based on poor earnings. Tech has already been taken out to the woodshed. Now that's starting to stabilize a little bit. So I feel that it won't take much for the market to get up over, say, 4,100. And a lot of people are going to be left on the sidelines. They're going to need to play catch up and really jump on board this rally. And, as the first quarter starts to move higher.
All right, we'll see what happens. And I'm sure we'll talk to you again soon. Mark Newton, thank you very much.
Thanks, Scott.